Hello there. Welcome back to Cost and Management Accounting N5. In this video, we want to look at Module 1. So please, let's not forget to subscribe and share to our channel. Let's not forget to share the link to our colleagues who are doing Cost and Management Accounting N5. And let's take note, we are going to have more videos that are going to come as we cover all modules of Cost and Management Accounting N5. And also, let's take note, we are going to upload typical examination questions that we are going to upload. So let's stay tuned. Let's get notified. Getting notified is subscribing and turning on the notification button so that you get notified of new videos that are going to be uploaded. So I'm going to our module 1. We are going to look at our module 1, which is on concepts and object. So we are going to start by looking at what is expected at the end of this module. So after one, you should be able to define cost accounting, differentiate between management accounting, and set the role of cost accounting, leading and controlling. And lastly, you are supposed to distinguish between cost systems. So these are the requirements according to our module 1 of cost and management accounting N5. So we are going to start by understanding what is a cost accounting. So you would see that these are the explanations that we are given in terms of cost accounting. So you would see that cost accounting basically is a process that involves tracking, analyzing, and reporting on the cost of a business, on the cost of the business's operation. So basically, we are saying the purpose of cost accounting is to help businesses manage their expenses, identify areas for cost control, and also make pricing decisions to maximize our profitability. So this is the basic explanation that we have in terms of cost accounting. So we have an explanation that we are given according to our textbook of Cost and Management Accounting N5, which reads, we are given examples of costs in a manufacturing concept, whereby we have got a direct material, direct labor, and all other manufacturing. So basically, we can start by trying to understand what we mean by direct material. So to see that direct material, these are physical components that are used to create a finished product. So basically, we are seeing that anything that is used to make a finished product, that will be inside that finished product, is part of that finished product, becomes direct material. So these are components that go into a manufactured product. That's basically what we are trying to say. So it becomes part of that manufactured product. That's direct material. Then when we look at direct labor, we are saying this involves wages, it might be wages and salaries are paid to employees who are directly involved in producing goods or are providing services. Those are workers that are directly involved in producing that product is direct labor. So we see that it's part of the cost of goods sold. It can be a significant portion of total cost of the project. So examples that we can try to come up with in terms of our in terms of direct labor, we can have if it's a producing company, manufacturing company, we are saying machine operators who are operating the machines that are producing that product are part of direct labor. Then we also have assembly line workers that are inside again the production process. We call them also part of a direct labor. So that's what we have. Then we're looking at the explanations that we are having now, that when the same cost accounting identifies measures and analyzes the direct costs connected. Then a second point, cost accounting also measures performance, product quality, product, and the second point that we have. And then the third point, cost accounting is internal evaluation and reporting on relevant cost. And then lastly, management mainly focuses on planning and control within the firm. So these are the explanations that we have in terms of cost accounting. So going forward, we now have the objectives of cost accounting. What are the objectives of cost accounting? When we engage in cost accounting, what do you want to achieve at the end of the day? So the first point is to provide information to management for planning, control, and decisions in decision-making purposes. This is the reason why cost accounting is often referred to as management accounting. So we are saying that as cost accounting, the process is to provide information to managers so that they can make decisions. So the decisions that are being made by the management are based on information coming from cost accounting. So basically, that's what we have. So basically, we can take, for example, a decision in terms of setting a price is we take the information from the cost accountant, the information that has been provided by the cost accountant in terms of the cost of that particular product can lead us to decide what price can we set basing on the information given from the cost accountant. So basically, that's what the first point is trying to illustrate. So this is the first point. The second point, cost accounting takes cost data, such as from different departments, and evaluates the data. And then management use that information for internal planning, control, to make decisions. Then we go to the next point. Decision taken can cover the whole spectrum of the business. Obviously, these decisions, obviously, they are decisions that are going to affect the operations of the business. So positive decisions, obviously, work in the positive direction of the operations of the business. So we go to the next point. The management team use the data provided by the cost accountant to decide on their actual and estimated results, which we call them control decisions. Then our next, efficient cost data provides the tools so that management can make the best decisions. Then lastly, managers are able to allocate and control available resources better and show bigger profits. So these are the points that we have in terms of objectives of cost accounting. And this is what we have on this part. So moving on to the next section, we have now the three cost components for a manufacturing concern, whereby we are saying the three cost components of the material. Concern is manufacturing overhead. We would want to understand what exactly we mean by manufacturing overhead. So manufacturing overhead basically is the sum of all indirect costs. Very important for you to take note that when we're talking about overheads, we are talking about indirect costs. So we are saying the sum of all indirect costs associated with the production process. So these costs are not directly related, or we can say labor used to make the product, but it's not directly linked to the product, but are necessary for the manufacturing to take place. So we are saying, for example, we're taking for example for labor, we are saying it's not labor that is directly linked to the production of that product, but it's labor that is necessary indirectly for the manufacturing to take place. So examples of overheads that we can try to come up with, we can have depreciation. It's an overhead, remember. Depreciation is it's an expense, remember, although it's a non-monetary expense, but it's an expense, so it's also part of manufacturing overheads. We've got rent. It's not directly linked to the production of a particular product, but we are producing it in a particular building which we are renting. So that expense is we call it a manufacturing overhead. It's not directly linked as compared to labor costs of the workers that are actually producing that product. So basically, that's what we have in terms of overheads. Then we have announced similarities of financial accounting and managerial accounting. So we are trying to find out about the similarities that we can have between financial accounting and managerial accounting. So I believe that it reads both use monetary terms. So this is a basics and rely on the responsibility concept. They rely on the responsibility concept, and the responsibility concept means we now have the differences between managerial and financial accounting. So the basic difference that is there between managerial and financial is that financial financial accounting is reporting. It's reporting what is transpired before. Remember, when you're preparing those financial statements, it's part of financial accounting. We are basing on what is transpired in the period that we've passed, which is different from managerial. Managerial looks into the future. For example, we are looking at budgets. We are looking forward to what is going to transpire in the future to come. So that's the basic difference that we can try to come up with. So let's see, according to the difference that we have, we see that the differences are classified. The first difference that we have, which is number one, it's on external versus internal users. Obviously, we see financial accounting, the information of financial accounting is used externally. Our external stakeholders are the ones that are interested in the information of financial accounting, whereby managerial is internal. We are saying the managers are the ones, the key players that are concerned about information of costing. So basically, that's what we have. So under external, we are saying financial accounting information is useful for investors and creditors outside the business. Financial information is prepared for externals. External users include creditor, part of the external users of financial accounting information. So under internal now, this is now applying to managerial accounting. Managers also need other information that is not presented in the financial statement. Managerial accounting information is used by people inside the business and is not available to the public. So you see now that in terms of managerial information. It's not information that you see on the financial statement. It's other information that is sourced inside the business. So we have got now the second difference is based on investment decisions and versus management decisions. So obviously, investment decisions is a part of financial accounting. Then management decisions is part of managerial accounting. So I believe that this financial accounting must be accurate. Shareholders have the right to know about the business they have invested into. They own the business. So obviously, we are seeing now financial accounting being related to our investment decisions. So we go to management accounting is useful for planning, control, and decision making. For example, whether a product can be produced profitably. So this is what we have. So we have now reason for information. Reason for the information. The information for managerial. It is a requirement by law that is financial statements must be audited. So this is applicable to financial accounting, whereby we are saying information of financial accounting in terms of those financial statements, they must be audited. It's applicable to all registered companies. This is the first point that we have. Then other management accounting is not required by law to be audited, obviously, and then managers need this information for timely decisions. That's the importance. So we see that under financial accounting is the responsibility, it cascades to external regulated bodies that are seeing what is transpiring in terms of how we are handling the financial information that we are supposed to present in a financial statement, which is a different issue under managerial accounting, whereby we are saying it's an information that is relevant only internal for the decision-making processes of of management. So basically, that's what we have. Then we've got dates of the information used. So on dates of the information used, financial accounting uses figures from the past, which is exactly as we are trying to explain. Then historical data, which already occurred, picked from source documents such as invoices and receipts. That is remember, source documents, that's where we have the accounting cycle starting. The accounting often uses budgeted figures that is estimates for the future costs based on past experience and calculations. So, although the information is based on past experience, but it's information that is relevant for the future. That is what is important, which is different from financial accounting. It's information that is relevant for the past. Because we are preparing the statement of financial performance, which is the income statement, and what we have the result of those statement of financial performance is reporting on what is transpired over the period. What is transpired in the past. If we made a profit or loss, that's the scenario. So this is what we have on dates of the future of the information used. Then we have got accuracy of the data now. Right? Accuracy is very vital or very pivotal. So we are saying financial accounting use accurate information and take time to be completed and interpreted. There are set of rules known as generally accepted accounting principles, which is GAAP, that has to be followed, which is different from management accounting. So management accounting places less emphasis on accuracy because of the budgeted nature of the figures. It is often necessary to use a budgeted and perhaps less accurate figures to make decisions in time for quick action. So the emphasis on accuracy, we can see it coming into play, that it's under management accounting. So this is what we have. Then moving on to the last part of the information that we have according to this video, we are now going to data used, basing the difference of financial accounting and managerial accounting, basing on data used. So on the first point, financial accounting has value, whereas management accounting does not only quantify in terms of monetary values, but it can use a number of units. For example, in the production process, we can have a production budget that is based on the number of units, not on based on monetary values. So basically, that's the difference that we can try to come up with. Management accounting also works with a number of other issuing hours, which is not found under financial accounting. So basically, that's what we have. A functioning of a specific department. So management accounting basically is an evaluation of functions of the business, when we are talking about departments of the business. Whereas financial accounting, when we are preparing a statement of financial position, it's a statement of financial position that is covering all the assets of the business, all the liabilities of the business, and the total equity of the owner. So basically, it becomes different. Whereas management accounting, it can be only information that is used to evaluate a certain function of that company. So basically, that's what we have. So that's now our reporting the information, and then we go to information, which is last part. Financial accounting uses the information which already exists in this coming up as a form as a form of repetition, as we have already discussed on the issue of using the information that already exists, information that is transpired in the past. Then we go to the next point. Management accounting uses outside information, for example, economic indicators. So you see that management accounting is it's very extensive, as it goes and looks at maybe trends of what is transpiring in the economy, out external information, which so we are seeing that under information, management accounting uses outside information. We're giving examples of economic indicators. So I think from there we can see that we have got more differences than similarities between financial accounting and managerial accounting. So this is what we have, guys, according to this video. And remember, this is only the part. It's only part of the module 1. So we are going to have other videos that are going to come that are going to cover module 1. So let's stay tuned for those videos. Let's not forget to subscribe. Remember, let's subscribe and share. We'll meet again in the next video. As for this video, I'm signing out.